Numbers don't panic, people do. Let's look at the psychology driving today's market. A dramatic event makes the news, and within hours, entire sectors shift as if the fundamentals changed overnight. But if you step back and examine the actual information, you often find the reaction was disproportionate. The data did not change as much as the collective behavior suggests. So what is driving the gap? Why does a single vivid event override months of accumulated evidence? The answer may lie in how the mind assesses probability itself. There is a well-documented cognitive shortcut called the availability heuristic. It describes the tendency to judge how likely something is based on how easily a similar example comes to mind. When something dramatic, recent, or emotionally intense happens, it becomes easy to recall. And that ease of recall can distort how we estimate the probability of it happening again. Now scale that distortion across thousands of investors making decisions at once. What you may find is a collective miscalculation, a shared overestimation feeding back into market momentum. The observable pattern is familiar. A company reports unexpected news, a geopolitical event erupts, or an indicator surprises. The market responds with a speed and intensity that appears to exceed the information itself. From a psychological perspective, this may happen because the event is vivid, it carries emotional weight, it is easy to picture, easy to remember, and therefore easy to overweight in a probability estimate. When many investors experience the same vivid recall simultaneously, the bias is no longer individual. It becomes a collective condition. The crowd shares the same distorted probability estimate. That shared distortion can drive coordinated action, buying or selling in response to the same recalled event rather than independent assessment. Pricing begins to reflect the bias, not just the information. This is where psychology intersects with market structure. The emotional reaction does not exist in isolation. It interacts with liquidity, positioning, and leverage, each of which can amplify the initial response. And there is a further feedback. The overreaction itself becomes salient. It generates attention. It becomes the next vivid event, reinforcing the very heuristic that started the cycle. The availability heuristic, as Tversky and Kahneman described, causes people to judge the frequency or probability of events by how easily similar instances come to mind, leading to systematic biases when recent information dominates. This means that if a market disruption happened recently, the mental image of that disruption is vivid and accessible. The mind treats that accessibility as evidence that another disruption is probable. Notice the distinction. The actual probability has not changed. What changed is the ease with which the previous event comes to mind, and that ease is functioning as a substitute for a probability estimate. Media amplifies this effect. When a dramatic event receives prolonged coverage, each repetition increases the ease of recall. The more often you encounter the narrative, the more available it becomes. But here is where individual psychology becomes a market condition. A single investor overweighting a vivid event is a personal bias. Thousands doing so simultaneously is a collective pricing distortion. When investors observe others reacting to the same event, the behavior itself becomes additional evidence. This is the informational cascade dimension, where each visible response increases the perceived validity of the reaction. The heuristic also interacts with structural market conditions. When liquidity is thin or leverage is high, a bias-driven move can be mechanically amplified by margin calls, forced liquidations, and algorithmic responses. So the availability heuristic is not operating alone. It is the psychological trigger that under certain structural conditions can initiate a chain reaction far exceeding the initial informational event. Here is the feedback loop. An unexpected event occurs. Because it is dramatic, it is easy to recall. Because it is easy to recall, investors overestimate its future probability. That overestimation is not random. It is shared. When the same event dominates media coverage, the recall effect is synchronized across investors arriving at the same inflated estimate at roughly the same time. Kliger and Kudryavtsev found that investors overreact to recent company-specific news, with readily recalled details shaping perceptions and resulting in disproportionate market responses consistent with the availability heuristic. The overestimation leads to action. Investors reposition based on the recalled event, selling assets they associate with threat, buying those they associate with safety. These are not random moves. They are correlated. When enough investors act on the same recalled event, their collective positioning moves the price. The price movement is now visible to everyone. It becomes a new piece of salient information. And this is where the feedback intensifies. The price movement itself becomes easy to recall. It validates the initial fear or excitement. Investors who hesitated now see the move and join. Media coverage follows the price movement, further increasing the salience of the original event. Each cycle of coverage, recall, and reaction compresses the feedback loop and accelerates the collective response. DeBont and Thaler documented a related pattern. Stock prices show evidence of overreaction to unexpected and dramatic news, with prior losers subsequently outperforming prior winners, consistent with psychological overreaction. There is often an asymmetry in this process. Negative events tend to produce stronger availability effects than positive ones. Fear is more vivid than optimism. A disruption is more memorable than gradual growth. As the feedback loop accelerates, position sizes increase. Leverage may expand. Momentum-driven strategies pile onto the trend. What started as a psychological bias is now embedded in market structure. Look, there is a contagion dimension here. When you observe other investors reacting, their behavior becomes part of your available evidence. The crowd's action becomes the most vivid and recent event you can recall. During peak availability, fundamental analysis can get crowded out. The narrative is so vivid, so emotionally charged, that slower and less dramatic evidence struggles to compete for attention in the decision-making process. The duration of this distortion depends on how long the event remains salient. If media coverage sustains the narrative, the availability effect can persist for weeks or months, keeping prices disconnected from underlying conditions. When the salience fades, when a newer event captures attention, the availability distortion begins to unwind. Positions built on inflated probability estimates may face correction as the recall effect weakens. So the mechanism is identifiable. Vivid events create recall ease. Recall ease inflates probability estimates. Inflated estimates drive correlated action, and correlated action moves prices. But does this pattern hold universally? Not necessarily. Some dramatic events carry genuine new information. A structural shift in supply or a sudden policy change can justify rapid repricing that looks like overreaction but reflects real conditions. The availability heuristic alone does not explain the full magnitude or timing of market moves. Liquidity conditions, leverage ratios, algorithmic trading, and institutional positioning all play roles that psychology cannot fully account for. Consider that a rapid market response to shocking news can be rational. If a large counterparty fails, the cascade of margin calls and forced liquidations is a structural event, not merely a psychological one. There is also a distinction between individual recall bias and aggregate market efficiency. Even if individual investors rely on availability, the market as a whole may incorporate enough diverse information to correct mispricing. Yet there are patterns consistent with availability-driven mispricing. When dramatic coverage precedes correlated selling and prices later normalize as salience fades, the sequence fits what the heuristic would predict. But recognizing this pattern after the fact is not the same as predicting it in advance. The availability heuristic describes a tendency in how people process information. It does not provide a reliable forecasting tool. So the thesis holds within boundaries. The availability heuristic can contribute to collective mispricing, but it is one factor among structural, institutional, and informational forces. Psychology explains part of the behavior, not the whole market. Which brings us back to the opening question. Why does a dramatic event move the market as if fundamentals have changed? From a behavioral perspective, the ease of recall is doing the pricing. Investors are not evaluating probability from first principles. They are estimating it from what comes to mind most easily. When the same event dominates recall for many investors, the result is collective mispricing. But this is not a complete explanation. The availability heuristic may initiate the distortion, but structural conditions, liquidity, leverage, and positioning determine how far the market actually moves. The value of understanding this mechanism is not in predicting the next move. It is in recognizing the psychological layer beneath the price action so that you can separate the signal from the salience. When a dramatic market event occurs and the reaction seems disproportionate, the availability heuristic offers one plausible explanation. Not the only one, but one that connects observable behavior to a documented cognitive pattern. The observer's stance is critical here. Price is evidence of transactions, not a direct reading of emotion. What looks like panic may be structural. What looks rational may be availability in disguise. Awareness of the heuristic does not eliminate it at scale. Even informed investors operate in markets shaped by the collective recall of other participants. The bias is embedded in the environment, not just the individual. The market does not simply overreact. It responds to the collective weight of biased perception. amplified by structural conditions that translate shared psychological distortions into observable price movements across asset classes. The availability heuristic is one lens through which to understand this. It is not a predictive tool, and it is not the whole explanation, but it reveals how collective perception can shape market outcomes. Start by noticing when a recent event dominates your assessment of risk. Ask whether the event is shaping your probability estimate through salience rather than through structural evidence. Separate the narrative from the frequency. Just because an event is vivid does not mean it is probable. Just because a story dominates coverage does not mean the underlying risk has increased. Observe the behavior, not the prediction. When you see a market moving sharply on dramatic news, ask whether the movement reflects genuinely new information or the amplified recall of a vivid event. Compare the behavioral interpretation with a structural explanation. Is there a liquidity event, a margin call cascade, a policy shift? The move may not need a psychological explanation. Remember that behavioral analysis is interpretation, not forecast. Understanding why the crowd may have overreacted does not tell you what happens next or when the correction arrives. This framework does not predict direction. It offers a way to study what happened and why, not to position yourself for what comes next. The availability heuristic helps explain how collective perception can amplify market movements beyond what fundamentals alone would justify. That is its contribution. Clarity about the mechanism, not certainty about the outcome. The crowd creates the feedback. Studying that feedback is the first step toward understanding market behavior without becoming part of the pattern. This is educational analysis, not financial advice. The availability heuristic reveals how vivid events can shape collective market behavior. Understanding the mechanism is the observation, not the prediction. Don't follow the herd. Study it. See you next time.